Welcome back to the podcast. Once again, joined by Ernest Wong and Warren and Charlie.
So there's a story about these ducks.
Yeah.
It's that I went to the Berkshire Hathaway AGM in 2015. And that was the only time I've ever gone.
Okay.
And at the Berkshire annual meeting, there's a big warehouse where you can shop around and buy things sold by Berkshire Hathaway companies. Mm-hmm. I didn't buy anything, but I did buy these two ducks.
Okay.
I think it was like $2.
Yeah.
When I was buying these ducks,
Yeah.
you can see that there's one is Warren and one is Charlie.
Okay.
But there were two types of ducks. There was the regular one, which I bought, and then there was a gold one, which is like literally exactly the same thing, except he's wearing a gold suit.
Okay.
And that one was double the price.
Yeah. And you didn't buy because you're too cheap?
And somebody who was there at the same time had the perfect response. He said, price is what you pay, value is what you get, which is exactly the point, right? You can buy the same duck with a different color for half the price, right? And it's still the same duck, and it still provides, I don't know, sentimental
So you bought
value.
these 10 years. They're probably worth more than $2 than what you paid.
Well, I don't know. I haven't
Maybe you can buy them on eBay. Yeah.
It's from the Oriental Trading Company,
Okay.
which is something that Berkshire owns. I imagine they probably sell them every year.
Yes.
So
it's for your little kids to play rubber duckies with
Exactly.
Warren and Charlie. Anyway, weird but cool. And what do you want to talk about today?
I thought the Bank of Canada interest rate decision on last week was interesting.
Okay.
I think everybody in the media and anecdotally seems to think that the Canadian economy is not good, right? Like real GDP per capita is weak. Like personal consumption is not good. Business investment's not good. But the Bank of Canada is still holding interest rates. I think one thing that's important to note about the Bank of Canada is that unlike the US, they have only one mandate, which is to control inflation, right? And so as long as inflation and inflation expectations remain elevated above their target rate
Long-term target goal, yeah.
of 2%, they're going to keep interest rates high, even if the rest of the economy is not good.
Ernest, when was the last time inflation was 2%? I looked at a chart from the US, for example, and it was even pre-pandemic, inflation was above 3%. And yet interest rates were incredibly low. I know they lowered them as a result of the pandemic, but is a target goal of 2%? Does that make sense? Especially when you're in a country like Canada where we import a whole heck of a lot of stuff. A lot of our food, because it's cold here most of the year. We import a lot of our goods because we don't really make things. We import a lot of stuff from Mexico, from China, from the US. Having a 3% inflation, 2% inflation target, is that nonsensical in this day and age?
I don't really have an opinion as to what the correct level of inflation is.
Me neither.
I think an overriding goal to lower inflation is a good thing by the Bank of Canada, because inflation is what they call the invisible tax, right? It's something that hurts all of us regardless of, and you don't see it, right? I think what was more interesting is that Tiff Macklem, which is the governor of the Bank of Canada, he specifically called out shelter inflation as a reason why he is reluctant to, or why the bank is reluctant to lower interest rates. And basically, I don't want to get into the nuances of the calculation of how shelter is in the CPI.
Our audience thanks you about that.
But basically, basically rents are still high. Rent is still going up in a lot of places in Canada. And housing prices are still expensive, right? And again, there's different mechanisms of how that flows into CPI. But to keep a long story short, he said, what we don't want to see is when we cut rates and then housing immediately pops back up and causes more inflation.
Which could happen because there are a lot of people waiting on the sidelines because housing prices are expensive. They are waiting for interest rates to at least come down so they can lock in lower rates to buy houses.
Exactly.
And that's going to happen. So
Right.
how do you combat that?
Well,
not cut rates.
It's a tough job. And,
Yeah.
and again, I think that he said very clearly, it's not the Bank of Canada's job to make housing affordable, right? That's a job for the government.
Yeah.
But that is certainly something that they are looking at quite carefully in determining what the rates are going to be.
Going off to quick topic, but you read that a number of groups are asking the Bank of Canada to now exclude shelter inflation in their calculation of CPI. They're saying a part of the reason that inflation is so high in Canada or above the target rate is because of the rise in mortgage rates, which is included in the calculation of inflation. And because mortgage rates have gone up, because of interest rates have gone up, if you exclude that, the things that matter for inflation have come down dramatically.
Well, I think
Is there any counter from what the Bank of Canada had to say about that?
I think there's another element as well, which is that the U.S. economy remains quite resilient.
Incredible. And goes to show you that having 3% inflation or not cutting interest rates doesn't seem to matter as long as earnings in the economy are doing good. No question it's going to hurt some pockets of the economy and may make housing less affordable for a number of people, rent, but you can't solve all problems with interest rates.
Yes, and there is the issue, and the reason why it matters is because to the extent that Canada cuts significantly more than the US, the Canadian dollar will probably be under pressure, which will raise the cost of importing goods.
Exactly.
Right? And so
That's exactly what we mentioned at the beginning. Okay, so what does all this have to do with long-term investing?
Well, yes. So we try not to invest in situations where they are heavily dependent on interest rates. So Domino's Pizza, a company that we own for our portfolios and have talked about several times on this podcast. Pizza consumption and how many stores Domino's is going to open in the future, it doesn't really have much to do with interest rates. Like maybe at the fringes, it kind of impacts the financing that franchisees might get.
That's right. And if Domino's balance sheet is levered, higher interest rates could hurt its ability to raise its dividend as quick as in the past.
Yes, it impacts it at the fringes, but by and large, it doesn't really impact the business too substantially.
Gotcha.
Right? So a lot of people pay a lot of attention to these kinds of things like interest rates, right? But I think the whole point that I'm trying to make is that you shouldn't pay attention to these things. And if your investment thesis is too predicated on what interest rates are going to be, then it's probably a sign that like you should be looking somewhere else.
Probably. And of course, lots of charts going around now showing that even with the fastest move in interest rates, inflation, interest rates not being cut, everybody was saying, well, those long duration assets and companies that don't have the near-term profits and aren't paying dividends, they should do the worst. Well, now they're doing the best, even though interest rates and inflation haven't come down to the extent that people think they should. So it's all about earnings and all about the quality of the business and the reinvestment of those capitals. And I think you and I shared a text. So like, who cares if inflation is 4%? If your business can reinvest the cash flow that it earns at 20%, does it matter if it's 4% or 5%? It may make like you said, a little fringe difference, but bottom line is it doesn't change the trajectory of the business.
Yes, well said.
Okay, so we're not going to make decisions here based on interest rates and inflation, but we will make decisions here based on the quality of the business, the quality of the management. And for us, Ernest, when we look at the types of businesses that we want to own for ourselves, for our clients, for our families, we've said it before, there's just not enough names on the Canadian stock market to build a portfolio. And so I spoke to a brother and sister prospect today, and I laid out to them that yeah, we're a Canadian company, but we're buying mostly US stocks. And some of the eyebrows turned like, what? What does that mean? What do you mean you're not buying Canadian stocks? And it was, yeah, well, we like companies that have great returns on capital. We have companies that are asset light, recurring revenues, and you can't find enough of them in Canada to do that. And as a result, our portfolio mix may be as much as 70% allocation to U.S. stocks. And your thoughts?
Yeah, I think it's an interesting question on what the proper allocation to Canada is for an equity portfolio. I think there's certainly benefits to owning more Canadian stocks as a Canadian. Number one is that we live here, and I think we inherently understand the companies that are here a little bit more than people who live elsewhere.
Possibly. I mean, there could be some retail stores or some services that you see advertised in the U.S. or on Canadian TV that you've never been to. You don't use those services, so it's not as meaningful to you versus having your cell phone with Rogers.
No, and I think more than that is that I think a good example that I like to use is Tim Hortons. Canadians are the only people in the world that essentially drink Tim Hortons.
Well, some people in Western New York would disagree with you in Detroit, but yes. Yeah.
It's very hard for a person in China, for example, to understand what Tim Hortons means in the Canadian context. Like why people prefer to drink this watery coffee, right?
But why would a brand like Starbucks just translate? Because it's in the U.S. and it's already built up that cachet. Because if it works in the U.S., then it's got to work everywhere else. But if it works in Canada, Canadian Tire stores aren't going to work in the U.S. That's for sure.
Right, and so I think that's one of the reasons why Canadians may often own more Canadian companies because they just understand these businesses a little bit better.
The Peter Lynch type approach. Invest in what you know.
There's also tax reasons. There's a dividend tax credit for Canadian companies.
That's right.
As we've seen, like Ferrari, for example, they recently raised their dividend as an Italian company, and we're not happy with
We're going to get punished with that. We'd rather have them buy back the stock.
Yes.
And you've spoken to a lot of Canadian companies as well as U.S. companies where the dividend is not as important as share buyback.
Yes.
And you'll speak to investor relations peoples of U.S.-based businesses, and they'll say, we raise the dividend because whatever, a few of our investors like it, but our institutional investors push for more share buybacks. Whereas in Canada, it's all about dividends. And I think because of the dividend tax credit, retail investors have benefited from dividends over the last 20 years because of interest rates going down. That's why so many of our parents, so many of that generation really liked those dividend payers. It worked for them.
And then lastly is that it's just easy to own Canadian companies, right? Like there's no FX translation issues when you are buying Canadian
There's
companies.
Zero currency risk.
Yes.
Although that's a misnomer. We can get into that. It may be a little bit deep in the weeds, but the currency, of course, the Canadian dollar right now is 75 cents US, give or take, 74 cents. If the Canadian dollar moved up 20% against you, that could be painful to your portfolio, especially if you look at your portfolio returns all in Canadian dollars. That hurts. The good news for a lot of Canadian investors that own U.S. stocks over the last few years is that the Canadian dollar has stayed within a pretty tight band of about 72 cents U.S. to about 80 cents U.S. So it hasn't moved or hurt you. But there was a point in my career where the Canadian dollar, people won't believe this, but was worth more than the U.S. dollar. This was when oil prices ran up. This was when people were worried about the U.S. deficit. But right now, of course, it doesn't look like the Canadian dollar is going to approach par anytime soon. But anything could happen.
Right.
Yeah.
So those are, I think, some reasons why you may want to have more Canadian allocation in your portfolio.
Why you might.
Why you might.
Maybe
yes.
not should.
But I think there's the flip side to your point is that Canada is just a fairly small country on a global scale.
Yeah.
And if you say you're only going to invest in Canadian companies, you're going to miss out on all the fantastic businesses that exist elsewhere. And that's the approach that we take here, is that we want to own good businesses wherever they are.
Exactly.
And most of them tend to be in the US, but we're open to owning Ferrari. That's in Italy, for example.
Exactly. And so a lot of Canadians have done incredible over the last 20 years, as I mentioned, because interest rates fell. We've talked about this on the podcast a lot, but it's important to reiterate the point. When interest rates were 2 or 3%, and a company was paying a nice 4, 5, 6, 7% dividend, there's good reason to have those stocks in your portfolio. But when interest rates now have normalized and they've come back to levels where companies now have to issue debt at 5, 6, 7%, or you can buy a GIC that pays 5% or quality bonds that pay 5%, the attractiveness of a company that has a dividend of 5% isn't that attractive anymore. And especially if you're owning a business that is levered, that is not as profitable when interest rates go up, that is facing possible disruption risk, then you have the potential of not doing as well in those dividend payers for that dividend factor that benefited you when rates were low. Mm-hmm. And I think, Ernest, by interest rates going back to 5, 6%, it's really unraveled or revealed a lot of the issues that people kind of ignored when interest rates were 2%.
Well said.
Okay. So when our clients look at their portfolios, they're not going to see a lot of dividend payers. We're happy if a company does pay a dividend, but we're looking more for the returns on those investments. And when you look for investments for our clients, yes, you said it would be great if we find Canadian names, but that's probably the last thing on your list is whether it's Canada or US, right?
Yes.
Yeah.
And a lot of the great Canadian stories, not all of them, but a lot of them, they do have dual listings. Mm-hmm. They do list in the US to allow investors to access them.
Yeah.
So Canadian Natural Resources, which we talked about last week, they have a US listing. The Canadian railroads list in New York.
Yeah.
And then there's a lot of those as well.
It makes sense. And if you were a Canadian investor and you wanted to buy one of those companies, you at US dollars, you can buy them on the US side. If Canadian dollars, you can buy them on the Canadian side. So things have opened up. There are a few Canadian companies like Couche-Tard or Constellation Software. CCL Industries, another one that we own, that have not listed on the US exchange. Why don't these, if you wanted to have exposure to the biggest market, you want to show the world that you're a first-class company, why are these Canadian companies so stubborn? Why is Alimentation Couche-Tard, which we now own the shares, by the way, has been one of the best performers over the last 35 years, why is it hiding away from US investors?
And Topicus is probably the worst of these. Like they list on the TSX Venture Exchange.
That's right. Topicus, the spinoff from Constellation Software. And if Constellation does go ahead with spinning off a number more of its entities, they're all going to be listed on the Venture Exchange. So your thoughts, Ernest, on why some of these Canadian companies are so reluctant to issue on the US?
Well, I think that a lot of these probably don't need to. Mm-hmm. Certainly, Alimentation, Couche-Tard is not lacking in capital.
Yeah.
Certainly it would allow them to access another investor base that otherwise wouldn't be buying the stock, but they're fundamentally a Canadian company. They have all the capital they need to complete acquisitions, as their track record has proven.
Yeah.
So I think they just don't feel like there's a need to, unlike TFI International, where they went into the US to gain credibility to make a big US acquisition.
Yeah, they were looking to make an acquisition, and they actually sold stock at that time, so there was currency.
Yes.
Whereas an Alimentation Couche-Tard, I think all of its acquisitions, or a lot of it recently, has been with cash or debt. Constellation Software hasn't issued a share since its IPO. So listing on the US exchange would just be for glory reasons.
Exactly.
And
I mean, they might get like a slight valuation bump, which maybe Constellation doesn't even want.
Yeah, no, it doesn't want. It would get. I think it definitely would get a valuation bump because it would. There has to be U.S. fund managers and U.S. Mutual funds that have in their mandates that they won't own a foreign stock unless it's listed on the U.S. exchange.
Can I make a side note?
You can say whatever you want as long as you don't swear. Yeah,
I think it's kind of silly.
Yeah.
that just because a stock is listed in New York, that it's now included in your mandate when nothing fundamentally about the company has changed at all.
Yeah, exactly.
I think that's ridiculous.
I guess it's just the bylaws, the charter that you've set out, that you've explained, and it's a pain in the tuchus to change that strategy. I don't know. I find it silly. I'm so glad that for our clients, for my portfolio, I can buy whatever I want.
Yep.
Within the certain guidelines, but no one's going to tell me that I can't buy a U.S. company because it's not because it's not in Canadian dollars. It's dumb.
Yes.
Yeah. Okay. So speaking of not dumb, Mike Rose at Tourmaline. Mike Rose is the CEO and founder of Tourmaline Oil, which is a natural gas company. He and his team have had tremendous success in the Canadian oil patch over the last, call it 30 years. Built two companies, one called Beverly, I think.
Berkeley Petroleum.
You know what? We actually used to own Berkeley. I don't know why I call it Beverly. Berkeley Petroleum and Duvernay Oil, both starting pretty much from scratch, built them out and sold them, and started Tourmaline how long ago?
2009.
2009, and it's been an incredible success story. Had you bought Tourmaline on its IPO, you would have made a ton of money. But Ernest, right now, natural gas prices are in the toilet. We haven't seen natural gas prices this low. I haven't seen this low in my career. It looks like nat gas prices go down every single day. And, the reason is pretty clear. It's been a very warm winter and no evidence right now. We're in mid-March that it's going to get cool again. So it's, it's a demand-supply business, and too much supply and not enough demand from furnaces to keep your house warm. So that's where natural gas is. But there's good reason, we think, to think that now's a great time to think forward about Tourmaline and why the future looks so strong, and why Mike Rose may turn another of his investments into another sale for his investors. So there's no reason to suspect that he can't do it again. So let's get into Tourmaline Oil.
One of the things that I've come to appreciate over my career is that there are outstanding businessmen or women.
Business people. Yep.
In any sector of the economy, right? You have the traditional, like the Microsofts and the compounders of the world, like the Warren Buffetts of the world, right? But then you also have someone like Mike Rose, who has this incredible track record of building up oil and gas companies, right? He, as you pointed out in the beginning, this Tourmaline is his third act. He built and sold two other oil and gas companies before this, including the most recent one was Duvernay Oil, which he sold to Shell at the peak in 2008. There's a friend of mine. He calls Mike Rose the Michael Jordan of oil and gas.
Michael Jordan of oil and gas. Okay.
And he just has this spectacular track record of capital allocation. So when he found, and I think the market realizes this, because imagine how hard it would have been to start and raise money for an oil and gas company in the financial crisis.
Pretty hard.
Yeah, and people gave him money, right?
Yeah.
Because they know what a great job he's done. And over the last 15 years, Tourmaline has started from nothing in 2009 to being the largest natural gas company in Canada, including buying back some of the assets that he sold to Shell in 2008 at a discount.
Because Shell ran into financial trouble because of the financial crisis, and natural gas prices plummeted as a result, and sell it back to me, baby. Yeah.
And this is a pretty common theme among the oil and gas companies that we own, both Canadian Natural Resources that we talked about last week and Tourmaline, is that they tend to zig when others zag.
Yeah. And by the way, the company's called Tourmaline Oil, yet 75% of its production is actually natural gas and natural gas liquids. Confusing, but Mike Rose doesn't care. What you think?
I think if you study the oil majors, the Exxons and the Chevrons and the Shells and those guys, right? Historically, they tend to, just like general investors, they tend to herd. They go to the most sexiest oil plays that everybody wants to be in at the same time, right?
I never heard sexy and oil place in a sense before, but okay. Yeah.
They are going to the Middle East if there's oil there, right? They generally, not to go into specifics, but they generally miss what's under their nose, right? They missed fracking in the U.S., the shale wells.
Yeah.
They exited the Canadian oil sands right at the very bottom.
I know, so ridiculous. They sold everything to Suncor and CNQ at absolute lowest price at the bottom.
And so you have Mike Rose, Tourmaline, and Canadian Natural picking these up at attractive prices.
Yeah.
And these are really, really good assets.
Is it just because they maintain a strong balance sheet and they know how to think long term, whereas Shell and Exxon, such boom bust businesses, oil and gas, that they have to meet quarterly profit and target goals in the short term?
Well, I think there's a few aspects.
Okay.
I think one important aspect is that by nature of being Canadian and not running a global energy company, is that you're a little bit more attuned to what's the attractiveness of the basins that you're operating in, right? Rather than just kind of playing around with your portfolio on a global basis.
Tourmaline is 100% pretty much Alberta oil and gas, correct?
Yes. So today, Tourmaline plays in, or they produce in the Alberta Deep Basin, which is a big natural gas play, and they play in the BC Montney.
Okay.
So those are their two major gas fields.
They're not looking for natural gas in Guyana or Ghana or offshore or any other crazy place to try and make a buck. Mike Rose and his team know Alberta. They know BC. They're comfortable with the geology, the testing that they've done, the drilling. That's where they feel the best opportunities for them and their shareholders are.
Yep. They are a low-cost producer. They own they own most of their gas processing infrastructure.
Very fascinating.
To optimize production.
So they're not paying a lot of contract. Well, they are paying contractors.
They're not using someone like Keyera, for example. They own their own infrastructure and they can optimize utilization that way to lower operating costs. They produce about 580,000 barrels per day of in oil equivalents of natural gas and other stuff.
So a fair bit of that natural gas, Ernest, is sent to the oil sands, of course.
Yes.
A fair bit is used for electricity, but the bulk of natural gas in North America is used for heating and air conditioning.
Yes.
Okay.
Yes. So they produce a lot of natural gas. They process it themselves. And one of the things that Tourmaline has done a pretty impressive job of is diversifying the markets that they sell their gas into, right? So I think something that may not be very, something that a casual observer might not know is that there's not one natural gas price, right? Like it depends on where you are.
Yeah. So when I quoted that natural gas prices are at their all-time low or near an all-time low, that is one natural gas price, but natural gas is geographic specific.
Yes.
There could be a California price, a European price, a Pacific Northwest price, wherever it's sold, that's a different price.
Yep.
Yeah.
And so the Canadian hub for natural gas pricing is what we call AECO, AECO.
Okay.
And AECO has traded at a steep discount to other benchmarks for a very long time because Canada cannot export our natural gas to higher markets.
When you have most of your processing in Alberta and there's not pipelines to send it to somewhere aside from Fort McMurray, you can't take advantage of a lot of different pricing.
So what Tourmaline has done is that they've successfully been able to diversify the places that they sell, right? So I printed out a little chart here.
Yeah.
I don't know
You
if
can share it about
you guys can see it.
No one's going to be able to see that. We'll share that in the notes. But yeah,
they send, basically they send a very large portion of their production to premium price markets like in California.
Okay.
They just started selling gas at Japan and Korea pricing. And they're able to consistently earn a better return for their natural gas than AECO.
Why can Tourmaline do this versus, Barry and Ernest natural gas company that's located in Alberta also?
It's because it's a big company,
Okay.
right? They have the scale to be able to make these contracts and the pipeline access and the facilities.
Gotcha.
Right? Whereas if I was drilling a couple wells randomly, I have no choice but to send it into those the regular AECO price, right?
It's not that they have better tasting natural gas or better smelling natural gas. It's because they have the size, the girth, the facilities, the infrastructure to send it to different places.
Yep.
Okay.
And Tourmaline has massive land inventory. It's about, I think they said 4.8 million acres of land.
What does that mean?
So natural gas is in the land, and if you have the land, then that's where you can drill for it.
So 4.8 million acres sounds like a lot. But
And proved reserves of 2.6 billion barrels of oil equivalents of largely natural gas, right? More importantly is that these are very, very big gas fields. So like all they have to do is go and really drill it, right? So there's a number called the finding and development and acquisition costs, right? And Tourmaline is able to basically spend $8 to $10 to find a barrel of oil equivalent of natural gas, right? And they earn about $20 per barrel. So you do the math, right? They spend $8 to get it out, to find it and develop it, and they earn $20 on it at current prices.
Because it's not that hard to find. They're good at drilling. The facilities are there. The processing is there. They have the people.
And so, pretty spectacular returns on their natural gas drilling.
But not with natural gas and AECO price in the toilet right now.
No, even still.
Even so.
Still. And I think more importantly is that there is a pretty healthy tailwind coming in 2025 with the completion of LNG Canada.
So LNG Canada is a plant that will be able to process liquefied natural gas and sell it to markets overseas, primarily Asia, and take advantage of the fact that a lot of Asian countries, like North America, heat their homes, need air conditioning furnaces, of course, need it for electricity, but don't have the inventory. They don't have access to natural gas. And where they do have access to natural gas are some countries that not necessarily you want to do business with. We don't have to get into the political stuff of that, but Canada and the United States seems like a more geographic and political business partner.
Yes. For these reasons, natural gas pricing in Japan and Korea, particularly for liquefied natural gas, is much higher than the price in North America. And so once LNG Canada is complete, Tourmaline is not, specifically itself, is not a participant in this project. So they themselves won't be able to send natural gas to LNG Canada. But the impact of this is that it will, about 14 to 15% of Canadian natural gas production is going to be sold to
overseas.
Asia.
Yeah.
So
versus zero today.
Yes, versus zero today.
Yeah.
So it's basic supply and demand, right? If there's 15% left gone, then that means that the rest of the price is going to go up.
That's right. And we've had a very warm winter. If 2024, 2025 winter is back to normal, and you have 15% of, well, it may not be essentially complete 2024, 2025, but you do the math. At some point, there's going to be less production on the market. You could have more normal winter weather. And we've got something going on, Ernest, called the electrification of the grid. We have more demand from EVs. We have the demand from data centers, which require electricity. You can't run all these data centers to process AI without using energy. You don't necessarily can fund everything from solar and wind. If it's not windy, there's no power. If it's not sunny and like in Canada, it's 6 months of the year, there's no power. You're phasing out coal. Nuclear power sounds good, but no one's building these things. What are you left with?
Natural gas.
You got it, baby. So the bottom line is natural gas prices are in the dumps today, but long term, there's a potential for natural gas prices to normalize. And in a normal environment where you have Tourmaline, as you explained, with a long-term production growth, lots of assets in the ground, low-cost producer, the company's results could be fantastic going forward.
Yes, Mike Rose recently gave an interview where he said everyone is focused on LNG Canada.
Yeah.
But they have to realize that the electrification of the power grid in the US is equal to one LNG facility every year.
Okay.
Right? So massive demand for natural gas.
And in the meantime, LNG plants are being built in the US as well.
Yes.
Right? There's fracking of natural gas and oil in the US. They want to get their LNG also to these markets. On one hand, of course, if all this LNG is going to the Asian markets, you could expect Asian pricing of natural gas to fall, but probably would still stay much higher than the pricing that the stranded natural gas in Alberta is getting.
Yes.
So what is Mike Rose doing with his money, Ernest?
Well, he's been basically buying back stock hand over fist.
Yeah.
He buys like every day.
He buys shares almost every day.
I don't really know where he's getting the money from.
Well, he's getting it from the dividend from
Yes.
Tourmaline. So Tourmaline is unlike Canadian Natural Resources that may buy back stock instead of increasing a dividend or paying special dividends. Tourmaline right now is focused exclusively on paying dividends.
They do. So
Yeah.
Tourmaline's capital allocation policy, they have a small base dividend. I think it's 30 cents.
Yeah, no, they just raised it. Yeah, so I think it's $1.20 or whatever.
Yeah. 30 cents per
Yeah.
quarter.
Yeah.
They pay special dividends based on where natural gas pricing is.
Yeah.
So in times when natural gas prices are high, they pay a lot of special
Yeah,
dividends.
last year I think they paid close to $4 in special dividends plus the base dividends. So you got almost $5 a share in dividends. This year, maybe half of that, just because natural gas prices are so low in the first half of 2024.
Yep. And to your point, in periods of low gas prices, they'll pay less special dividends. And then when the shares are abnormally cheap, they'll buy back some stock, although they haven't done that too much of that recently.
No. One of the things, obviously, we didn't even talk about is because natural gas prices have been so low in a lot of parts of North America, companies are now shutting production or reducing production.
Yes.
Whereas Tourmaline is a low-cost producer, owns a lot of its facilities, has a beautiful balance sheet. It can afford to slow its production growth. Why sell natural gas at $1.60 when you know it could recover back to the $3 level in a year or so? It's stupid. But the companies that may have worse balance sheets don't really have that flexibility. But I don't think, Ernest, a lot of companies can make money in North America selling natural gas based on where the overall average price is today.
Yes, and they may also do acquisitions as well, which they have a history of doing.
So you've got a CEO that's worth a lot of money, who's already sold 2 companies, now has a third company doing great, and he's, I think he's past 65 years old, and he's still buying stock in the company. Doesn't need to. Could be sitting on a beach somewhere, counting his money, but here he is, just like you, regular shareholder, buying more shares and very excited about the future of Tourmaline Oil.
For some reason, I don't see Mike Rose as somebody who would enjoy sitting on a beach.
We don't know him, but I think it's someone called a lot of these guys who run businesses who are billionaires or close to billionaires, worth a fortune, who just show up to work every day and do their thing, psychopaths. They're just, I don't know if that's the right term, but they're just so in love with the business. They're so in love with working. How many days in a row can you play golf or go sit on a beach or read a book? That they've decided that they get more excitement, more enjoyment from showing up to work, doing what they've been doing, grinding it out, and that's enriching shareholders and their employees.
Well, you could tell when he started Tourmaline in 2009.
Yeah.
Right? That he wasn't going to just hang out.
Yeah.
Right.
So we'll take those odds of investing with those type of managers, those type of CEOs that love what they do. And Ernest, your thoughts, any final thoughts on Tourmaline?
No, I think it's so I think with regards to commodity businesses in general, right? I think a lot of, especially generalist investors who who spend time looking for great businesses, right? They like to ignore commodity businesses because, like we like pricing power, we like
asset light,
and this is by definition a commodity business is none of those things, right? They don't control the price that they sell at. It's very capital intensive, and the whole sector has a poor track record of capital allocation. But I think that with Canadian Natural Resources and Tourmaline Oil, and there's probably others out there.
Yeah.
I think at the end of the day, what you have to focus on is the cash flows, right? And these are tremendously cash flow generating businesses, which is what, if you're investing at the end of the day, that's what you're looking for.
Yeah.
And so I think it's a good idea to be a little bit more open-minded about the types of companies that you can buy in a portfolio.
So before we finish off, in their presentation to investors recently, Mike Rose and the team shared a slide about the Magnificent Seven compared to his company. What was that all about, and what is he trying to convey comparing Tourmaline Oil, which is not a technology company, not really an AI play? What is that? What point is he making comparing it to the big tech names?
Well, the slide basically showed Tourmaline's returns on invested capital versus the Magnificent Seven and other oil companies, and said it's more of like a humorous point to prove that we're a pretty good company.
Yeah.
Our returns on invested capital are good, and we're available at a much cheaper price than the Magnificent Seven.
Yeah.
Now, I think nobody is saying that Tourmaline is. Even Tourmaline would probably tell you that they're not going to get a valuation close to like Microsoft or Apple anytime soon.
No.
But I think it's an interesting point in that to demonstrate that you can earn good returns on invested capital with a natural gas company.
That's right. And if you're looking for long-term compounding names, that's a metric that's very important. The ability to reinvest the cash flows that you earn back into other investments. And if you're earning double-digit 20% returns on invested capital over a 4 or 5 year period, you're going to have pretty good results for your shareholders. So that's all we have for you this week. We'll see you back here real soon. Take care.